lecture in February when we had Jeff Rakes, the CEO of the Gates Foundation, and Greg Page, who's the CEO of Cargill. And those of you who were there, it was a great launch in terms of listening to two leaders in the field giving their various views from foundations and firms. We're equally lucky today to have two speakers, who I'll introduce in a minute. But before I get started, I just wanted to note that I think today is our first series in what we would call the core curriculum of the Symposium on Food Policy and Food Security, where we're actually going to get down to some of the theory and lessons of development that we want to convey not only to this community at Stanford, the faculty and students, but to a much broader international community. This series was really conceived initially as a mechanism to train and to provide real cutting-edge thinking to master's students that are funded by the Gates Foundation in both Africa and South Asia. And so students from both of those large regions will be listening to these talks, listening to your comments, so ask really good questions. You'll be on tape today. But it broadened out to actually include audiences here at Stanford, in other programs around the United States and abroad that are really focused on food security and food policy. And we've been, I think, very lucky to now arrange a series of who we think are the top thinkers in this field and leaders in the field of agriculture, development, and food policy. So today I want to introduce two of them, and we're really lucky to have them today. Our main speaker is Ousmane Badiane, who is from Senegal. And actually, Ousmane is from the heart of the groundnut production area in Senegal, which is the global center of groundnut production. And as we listen to the talk today, I think it's worth noting that if Senegal had developed its groundnut economy, which peanuts economy, in a way that really fueled the economic development process, they might have had agricultural lift them out of poverty. And that's really the topic of the debate today. So I think Ousmane comes from really his own experience in this field, but has had a very esteemed career. He went on to the University of Kiel, where he did his master's and his PhD, and then went on to the International Food Policy Research Institute, IFPRI, in Washington, where he was a senior researcher for almost a decade. And during that period of time, he was also an adjunct professor of economic development at Johns Hopkins in their Advanced International Studies program. And then he was lured to the World Bank, and he can give you this story on his own. He resisted the World Bank for a while, but actually went and worked for the World Bank for a number of years between 2002 and 2008, where he was actually leading their Africa program at the World Bank. And then went back to IFPRI in a very interesting way, where he has been a lead player in the collaborative African Agriculture Development Program, where he really felt sitting at IFPRI was a much better venue to actually get a consolidated and comprehensive policy response to Africa within the region on agriculture. So I think he comes with substantial experience from leading institutions and a lot of really, really good on-the-ground work that he can explain to you, starting from when he was growing up till today. He spends most of his time, as far as I can tell, in Africa, and he just jetted back here temporarily to speak with us. He's written very widely in the field of agricultural development, with major contributions on trade liberalization, agricultural productivity, market integration, food security, and macro policy. And so today he's going to talk about a topic, well, we gave you the title actually, why has Africa been so slow to develop its agriculture? But that's AKA, for those of you in the field, it's really about the process of structural transformation, how development policies in Africa have either helped or hindered the development process, both with respect to agriculture and the economy as a whole. So we look forward to your comments today. We also have another very esteemed speaker who's going to comment, Peter Timmer, who many of you know and maybe have even taken classes with here at Stanford. He has this quote-unquote retired title, but as far as I can tell, he's really not at all retired, and he's very active, particularly in Asia. Peter was trained at Harvard, both as an undergraduate and a graduate, did his PhD in economics at Harvard, and he's had a very distinguished academic career here in the United States. He was a tenured professor here at Stanford in the Food Research Institute when it existed, then went on to be a Babcock Chair at Cornell, a Cabot Chair in Development Studies at Harvard. Really, he was a professor at large at Harvard for a long time, as far as I remember, a dean of the School of Pacific Studies at UC San Diego, and he was also a senior fellow here at Stanford, as well as a senior fellow at the Center for Global Development in Washington. And as a senior fellow here, I might add, he was one of the main people who conceived this whole symposium idea. So he needs to be credited for that idea as well. He's had a long-term collaboration with Stanford. He's been an author of 5 books. The most notable ones that many of you have studied under have been Food Policy Analysis, which is translated into 13 languages now, I think, and Getting Prices Right. Peter has also had a long-term advising role in Indonesia and half a dozen other countries. When we talked prior to this meeting, He was just in Vietnam. He's going to Vietnam, Beijing, Australia. There was 4 other countries before October, I think. So he's accumulating miles pretty rapidly. And he's also won a Medal of Merit by the Indonesian government for their assistance on development strategies. So he's been a contributor in the field of economic history and economic development, really well known for this field of structural transformation that he will comment on today, with particular emphasis, I think, on Asia. So we welcome both the speakers. We'll have talks for about an hour and 15 minutes, and then lead to a discussion. And so write your questions down. We hope to really spark a very good discussion around this topic. It's an important topic in the development area, and one I think that is changing very rapidly today. So we welcome you, Ousmane Badiane. Thank you.
Thank you. Thank you, Rose, for the kind introduction. Something you didn't say, but you couldn't have known, is that I have studied both Peter and Walter during my grad studies in Germany in the early 80s. So it's an honor for me to share the podium with you and also to be invited here by Walter. Thank you, everyone. Let me start this. I've been asked to talk about agriculture and structural transformation in Africa. I will do that by looking at 5 different issues I would like to go through very quickly. But I will start with my key messages. I won't repeat them, but I hope you'll keep them in mind while I'm developing the body of my presentation. I will then talk a little bit about the growth process and give a brief overview of recent performance in Africa. Then discuss the pace and the patterns of structural transformation as we have seen them over the last few decades, comment on future strategies in agriculture, and then close with what I thought needs to be done for the industrial sector. My key messages, the first one is that we did have structural change in Africa, but it was productivity reducing, opposite of what we would expect. And I'll discuss that a little bit, but that's the first message. The second is we did see in Africa the kind of diversification that moved labor from the underperforming but higher productivity agricultural sector into a lower productivity service sector. And that is at the root of the negative, or at least the productivity reducing structural change that I talked about. It's also notorious to see that in Africa, beyond the 60s, African countries really don't have any effective industrialization policies. And that's important because industry is the other part of the economy that plays with agriculture in the structural change process. So that impeded growth in manufacture and forced a specialization of the economies in low value primary goods. There are several reasons for that, but at least that is what happened. Now, what is then the way forward? Still in my key messages. There are things happening in Africa that are right in the agricultural sector, and I think that ought to be sustained, and we'll discuss that. We have quite the longest period of sustained growth in Africa over the last 15 years, and I think that ought to be sustained by improving policy planning and implementation, and I do believe that should be through evidence-based and inclusive policies. But also Africa will need to renew its industrialization policies. They just need to find a way of dealing with industrialization. And finally, my last message here is that African countries will not have a choice but to look at social services differently than they're looked at in the developed world, or they're being looked at traditionally. They have to look at them from a productivity enhancing point of view and not an entitlement point of view, and we'll talk about that. Now, the growth process, we know, I'll state it, I won't comment too much on it, but we know that countries become rich by producing more per given worker. And this they do in different ways, at least producing more of the same goods per worker, but more importantly, producing a larger basket of higher value goods. That is really the crux of the structural transformation process I would like to talk about. But also we do know that countries become rich over time. And that process have them starting from agriculture and the rural side of the economy, moving slowly to an urban and industrial base. We also know that this growth process has a couple of challenges that all countries have to deal with, including African countries. They got to raise productivity in agriculture and rural economy while diversifying into higher value goods outside of agriculture. These sequencing and synergistic movements sometimes can be very complicated in terms of policy making. And I think that has been quite a big challenge in African countries. The factors that determine that process, human and physical assets, institutional and technological resources, as well as policy and coordination capacities, all do play quite a big role. Now, a review of performance in Africa. I was just saying when I started that the last 15 years have been the longest sustained period of growth in Africa. We can talk about why in the discussion, but I wanted just to put it here in front of you. And what's important is that growth is not accelerating, and the projection we have now is that it's going to go towards 5.5% next year. Even in the deepest crisis of the 2008 year, growth was still positive in Africa. So something is happening, and we can discuss that. But I want to leave with you the fact that Africa is now enjoying its longest sustained period of growth since the independence. And the growth is just not accelerating, as you see from the curve, but it's spreading. On the map, you have light to dark colors. The darker the color of a country, the higher its growth rate has been. And you look at the two maps, the one to the right has much more darker countries than the first to the left. So the growth process is not just accelerating, as you saw from that graph, but it's spreading to more and more countries. This is not by chance. Something is happening, and we can discuss that later on. But this is what's happening. Now, that progress is not enough, although it's quite remarkable by African standard, to undo the preceding decades of stagnation and decline. So it's put Africa back on the path to growth, but there's a lot of catching up to be done. And that's why I think our discussion today is relevant. Africa has started something again, doing it right, but it has a lot to do, and it has to learn from the past and the mistakes so that it can correct things moving forward. This is then the time for me to talk about the pace and patterns of structural transformation. And here, a graph from, from Peter. And I want you just, as you know, most of all, what we would like to see during the growth process is agriculture GDP going up. But the share goes down while the economy basically grows. Agriculture still keeps on growing, but it's growing and becoming part of a bigger system. While employment in agriculture falls faster than GDP in the overall economy falls. And therefore, you have a higher per capita GDP. That's really what we would like to see. Okay. Now, I do think that we didn't have it in some African countries, most of it, and we're going to discuss why. And I would like you just to focus on the shape and of these two curves, and I'll lead you through a few graphs to basically describe what happened in Africa over the last 25, 30 to 40 years. Here you look at those two lines, and that's Africa overall, the share of employment and the share of agricultural GDP. And this gap, when it narrows, is when actually the share of GDP and the share of employment in the economy tend to converge, as Peter puts it, and that's when people in agriculture get the same level of per capita income than outside of agriculture. So the speed at which these two converge and this difference goes to zero is what you would see in a successful transformation process. Now, you look at Africa in general, the curve hardly moved. Therefore, incomes in agriculture were not converging towards income in the rest of the economy. So people in agriculture were just not getting richer and wealthier, except in North Africa, where you see quite a nice trend upward. Here we have different regions. The only place where you can see somewhat of a movement is in Central Africa. Actually, a little bit of a deterioration in Eastern Africa, but in general, not much has happened. So structural transformation did not really move quite well. Now, in some cases, it is the labor share that stayed high. In others, it's just that GDP was not growing fast enough. So you haven't seen the kind of movement that you would have expected. But we didn't have enough time to go much further. We started in 1980. But still, from there, I don't think that we have seen much movement. Okay. Then you look at what happened to labor productivity in agriculture and in non-agriculture. And here we start to see why structural change has been productivity reducing in Africa. You look at labor productivity in agriculture, which did not perform quite well, but compared to industry, which fell quite rapidly. Okay. So, and you have here the share of labor in agriculture, which was declining, but declining slower than labor in the lower labor productivity sector was increasing. So labor was moving outside of agriculture much faster, much slower than it was increasing in industry. What it does is that people are moving from a high productivity sector into a low productivity sector. Now, people say, how comes? Because non-agriculture ought to be and should be more productive than agriculture. And I think what's here is that this sector has a huge service sector, and you'll see it later, a low productivity service sector. The non-agriculture sector in Africa is not primarily manufacturing. And we can discuss what that is and what's behind it. Now, because of that, this movement, agriculture and non-agriculture did not really contribute positively to productivity growth due to the movement of what happened in the two sectors. The non-agriculture sector, which has increased its labor share, has not exhibited high labor productivity increases. So labor was going, labor that went into non-agriculture was basically leaving a high productivity sector, quote unquote, and going into a low productivity sector. It improved a little bit in the 90s with the beginning of the recovery process. And the contribution of both sectors was better in the latter part since the 1995 to 2005. But as you will see, it's really not enough. So the bottom line here is that non-agriculture has contributed negatively to productivity growth across all major reasons that you see. And that non-agriculture sector is not manufacturing, it's not industry, but it's an oversized service sector, as you'll see later. When you look at what happened, you have two processes that take place. Productivity growing differently between sectors and labor moving between those sectors. The extent to which labor moves from a low productivity to a high productivity sector, you have positive structural change. If it's the reverse, then you have negative or productivity reducing structural change. And what you have here in most African countries, structural change has been contributing mainly negatively to productivity growth in all major regions, except West Africa and to a lesser extent in Eastern Africa. So labor was not moving into high productivity sectors over time. Why is that? Is certainly quite an important question to look at. And here we look at individual countries, and the bars show the contribution of structural change to productivity growth. About 40% of African countries did have a negative contribution of structural change to productivity growth. Labor was just not moving into higher productivity sectors. That improved a little bit in the next period, but there's still quite a good chunk of countries where structural change is just not taking labor out of lower productivity into higher productivity sectors on average. Okay. And we'll see, as I said, what the reason is. And here's what I saw is the real issue. We tried, and this is something that really occurred to me, and that goes back to my Granite Basin experience. I look at macro accounts of African economies, and you see in the agriculture sector less than 20% share. Okay. And I say, then what is happening outside of agriculture, and where are the people working? What's happening to this economy? There's no way you can explain an African economy in general. There's some those, don't have like Djibouti and others. But a country like most of the 53 countries in Africa, with an agriculture sector GDP share of less than 20%, raises questions. Okay. And what we did look at over 200 countries, what should be the expected share of agricultural GDP based on per capita development. And you see that for most African countries, the solid line is what the observed share of agriculture is in GDP. And the broken line is what it should have been in most of these countries. So the negative structural change that we talked about is that most of these countries did not grow their agricultural sector the way they should have. For whatever reason, and we can discuss that, but agriculture has just plummeted too fast and too quickly in those countries. And what happened when it happened is that the service sector picked up most of those folks. Here too we see that the observed share of the service sector in most of these countries is much higher than what it should have been based on their development, level of development. So you have the higher productivity sector, which is agriculture, being drawn down too quickly, and then the lower productivity sector, which is services, to being basically pushed up. For whatever reason they are, we can discuss that, but that is what's happening. And if you look at the next charts here, you look at African countries at a per capita GDP of about $600, with an agricultural sector that is much lower compared to South Asia with a similar GDP, and almost the size of agriculture in Middle East and North Africa with a GDP per capita 3 times higher, and barely higher than in East Asia and in the Pacific. These countries these are much more mature economies, therefore should have much lower shares of agriculture in the economies. But African countries just don't have that size of agriculture in the economies. For whatever reason, agriculture is not performing at the level it should have. It's not claiming the part of GDP it should. It's not claiming the part of employment it should. But then you look at services. The service sector in Africa is second only to Latin America and the Caribbean, which have an income that is 7 times higher. So the service sector is bloated and bloated and bloated, while the productive agriculture sector is being undermined. And that has been the driving force behind structural adjustment in Africa. And that's why it's been productivity reducing and not productivity increasing. And that, of course, did have a lot to do with poverty. Here we have a relationship between the difference between expected and observed GDP share of agriculture and how it relates to the rates of poverty. Unless they fix the issue around agriculture, it's going to be very hard to do something about the poverty rate in Africa. Now, let me go to the strategies for agricultural sector, and hopefully something is going in the right direction here. Now, this graphic, again, is just showing what I think is what's happening in Africa. You have employment in agriculture that is not falling fast enough because there's nothing else that's happening outside of agriculture to pull that labor, except the low productivity service sector. So agricultural labor is just not falling fast enough. At the same time, due to neglect or whatever it is, the share of agriculture in the GDP is falling faster than it should have been. So the gap here is raising the income gap between agriculture and the rest of the economy and creating the poverty issues that we see. So African countries really will have to struggle hard to bring these curves back down to what they should be. Okay. And how are they doing it? Let me first talk about what the agricultural sector contributes and why it is important, and why these 2 things that I showed you, why this widening of the distance is causing problems in Africa. We looked at the relationship between agricultural growth and non-agricultural growth, several countries and over many decades. It's very hard to get a number on it, but if you just would dare to have an average, what we saw was that a 1% incremental growth in agriculture raises growth outside of agriculture by 1 to 1.3%. Okay. So when you grow agriculture, you're not helping rural people, you're not helping farmers, you are fueling the engine of your economy. And the fact that African countries have a way too low share of agriculture must affect growth outside of agriculture. Another way of looking at what agriculture does, you look at if you have a good performing agricultural sector, you're trading and you're bringing money into the economy. Here too we see that if these countries were able to maintain growth in agriculture and expand the exports like they did after independence, a 1% increase in exports would have raised growth in industry by up to 1.8%. Again, this shows us the cost of an undersized agricultural sector in Africa and what it means for the structural transformation process. It's just not at the macro level, even at the local level. A $1 that comes into the rural economy creates an additional $1 to $2 income that is spread around the rural areas. If the farmers get $1 additional income, everybody around them can get up to $1 to $2 additional income due to the fact that they spend that dollar on baskets, on household goods, on what have you, which creates multiplier effects. Again, just to underline, the fact that agriculture has underperformed in Africa is a much lower share of the overall economy. It's causing problems in terms of fueling growth outside of agriculture, but also creating wealth in the rural areas. And that's the real issue they have to deal with. Now, that's the past. But let's look forward in the next 20, 25 years. And here we have projection of just urban demand in Africa for traditional staples in Africa. You look at the bars, those in light blue are the level of demand in 2000. The darker blue are the level of demand in 2030. High-value exports in commodities that are exported in general, these are the teas and the coffees, and these are the new high-value exports, would increase by a total of 2 here and 7, about $10 billion. But the urban food will go by $100 billion. There is a scope to reverse some of that underperforming agriculture sector if the African economies can get their farming sector to exploit the potential for demand that's there. And with faster-growing economies, faster-growing populations, this $100 billion additional may be an underestimation. So there is a lot that could happen. And if they did, income going to smallholder farmers could total about $30 billion just from here. Now, to have an idea of that, what it means, the average African economy outside of South Africa and North Africa is about $10, $15 billion. So having an additional $30 billion is a ton of money in relative terms for African farmers. Now, African countries, fortunately, are doing something that may reverse what happened to agriculture if they commit to the new developments and they sustain it. One of them is the Comprehensive Africa Agriculture Development Program, which is a true platform for policy renewal. We can discuss the detail a little bit, but I'll just describe very quickly its main features and share with you what it's starting to do. For the first time in history, African countries have declared and embraced an agricultural growth strategy. They haven't done so in the past. They have developed a common framework at a continental level with 4 main investment pillars: land and water, agribusiness and markets, hunger and social protection, and science and technology. It is a process that's Africa-led, and that is coming from within, unlike some of you have heard about the Lagos Plan of Action, which was, the structural adjustment policies, which came from Washington and pushed down the throat of governments, was right in its prescription in many cases, but unfortunately not always properly implemented because of resistance and whatever, and we can discuss that as well. But it came from outside to respond to real problems in Africa. It is inward-looking in a sense that African countries under this program take a good look at their mistakes and what they can improve. In the Lagos Plan of Action that they had in response to the structural adjustment policies, everything that was wrong was from outside. There was nothing that was wrong from within. And then finally, there's a very strong focus here on governance, on review and dialogue, basically to change the way they do business. I will lead you through one of the main features of that policy. It's too broad itself. It could have been a discussion, but I'll just go through it very quickly. In this program, African heads of states have decided that each and every country should shoot for a 6% annual growth rate and should allocate at least 10% of their budget to agriculture to reverse the trend that I was just discussing. So what they do, therefore, they go country by country and systematically and look at what's happening and take stock to make sure that each and every country is on track to achieve those 2 objectives. And if they don't, to identify what the gaps are and find sector policy, budgetary, development assistance, and other commitments to make sure that those things are overcome. And as we speak, the 26 countries, 50% of African countries, are going to sign the documents in which they commit to do what they need to do to achieve those targets next week, okay? Which is the Central African Republic. They put a lot of emphasis on review and learning, and I'm just flagging here a website that's been set up to support that framework. If you have time, go through it, resacs.org, resaks.org. Quite nice program. What it does here is that when you go here, you have about 24 indicators. You click on the indicator, and in this map, on the map, you click a given country, and then you have a graph that comes here that shows you how the country is doing compared to the indicator. And you can move your cursor around, and you're able to compare that country to any other country in Africa. It's actually a tool we want ministers and director general ministers to see and compare, and then benchmark each other. Now, what's happening in response to this program? More countries are growing at 6% rate. More countries are getting close to the 10% budget targets. Here you have the trends of countries who are moving toward the 10%, and countries who are between 5 and 10%, and countries who are still under 5% budget. So something is happening there. They're putting more money into agriculture. And they have also much better policy documents and strategy documents. The global community is responding. ODA into agriculture in Africa is going up, and sharply lately. I was just mentioning to Rose that just last year, 5 countries in Africa claimed about 10% of the overall ODA that Africa has gotten every year. And the first country that signed the compact, Rwanda, has quadrupled its expenditures in agriculture over 3 years. Now, here, the real issue about the challenge is Africa is starting from a very high level of poverty. And even if all those countries achieve the MDG poverty target, you'll still be left with about 30% poverty. What that does to the African countries is that we'll have a lot of pressure to satisfy social needs to mitigate the impact of poverty. Okay? And if those countries could grow at 6%, some of them will have poverty rates that will still be higher than the MDG. So poverty is going to be a structural feature in Africa for a few decades to come. And that's important because the pressure to spend on social services is going to be there. But how do you deal with it if you have to invest in agriculture? The second graph shows that for these countries to achieve the 6% growth rate, these yellow bars are the incremental growth of budgetary outlays for agriculture, double-digit growth in agriculture, while you're having a higher and higher burden of social needs. So African countries cannot do both. They cannot invest to sustain growth in agriculture and invest to respond to the social needs of the poor people. So what will they have to do? They will have to see how they can use these resources, which are much more than agriculture, education and health, and here's agriculture. These should not be seen as lost to agriculture. They should harness this money to help sustain faster growth in agriculture. That requires them not to look at social services from an entitlement point of view, but from a productivity enhancing point of view. And how do you do that? You stop looking at social services as a composite. Health is health, education is education. Nobody does it for infrastructure anymore. We know that there's a difference between an airport, a port, a highway, a secondary road, trucks, and trails in terms of what they do to agriculture. And we do believe, and we're doing the research at IFPRI, we don't have the final results yet, but we do believe that several services within health and several within education and social safety nets have different impact on labor productivity in rural areas. So the question is, how do you optimize your expenditure within this health budget, your expenditure within the education budget, so that you impact labor productivity as the highest? So you're basically looking at health and education not as an entitlement for the poor people to have, but as a tool to raise their labor productivity. And you optimize how you do that across different labor. And let me now go to the industrial strategies. We can discuss a little bit more on what that means for health and education. Here, too, I'm going back to the same diagram. What you would like to see is really the non-agricultural sector growing, while agriculture still keeps on growing, but to claim a low share. So you want more sophisticated production and exports goods so that GDP per capita can increase. That's what you would like to see. And we have a number of indicators to show whether or not African countries have been able to do that. Now, we just looked at the agriculture story. Now we're looking at the non-agricultural story. And here we're using an indicator that your colleagues at Harvard have developed, which is basically a measure of the extent to which a country has a revealed competitive advantage in more sophisticated goods and higher value goods. Okay? And you see that African countries started strong in the 60s, and then everything fell flat. Okay? You look at the countries that were in the same neighborhood. South Africa has been able to, to catch up and stick with these countries, but most African countries just have fallen flat since then. So agriculture was going slow and being depressed, while the rest of the economy was not doing what it was supposed to do in innovating and producing more sophisticated goods. That's why structural change was productivity reducing. You can look at agriculture and non-agriculture. Again, here, you can see non-agriculture flat, agriculture even flatter. There's a little bit of a change here towards the turn of the century, but basically, after the 60s, and we can discuss what happened there, there's nothing much in terms of sophistication, higher value products, and so on and so forth. And you cannot get positive structural change if you don't do that. As a result, the only countries that have been able to have a much more sophisticated economy and grow agriculture are all primary goods, oil and mines and what have you. And this is not the kind of products that creates labor. Okay? So there's a real issue there. So African countries do need a non-agricultural development strategy that should be based on a much stronger performing agricultural sector. That's really the simple answer. How to do it is tough, but that's where they need to go. So how do you do that? Africa needs really to have an industrial strategy, renewal. They tried it on wrong footing in the 60s. We all know about import substitutions, government-led industries, and so on and so forth, which explained that sharp increase, but then flat because it wasn't sustainable after that. And they burned their fingers and then ran away from it. And they can't do that because the economy needs to move towards higher value goods, more sophisticated goods that raise average per capita, that raise productivity so people can leave the agriculture sector and the lower productive service sectors into something that's more gainful. So they have to do both, and they need to know how to do that. Now, as I've shown with the Comprehensive Africa Agricultural Development Program, they may be onto something okay with agriculture, but industry I haven't seen much, okay? So that's why I think it ought to be the focus of discussion. Now, in addition to sustaining the momentum in agriculture, now, what is the industrial development process? Industrialization happens through the production of new goods in most cases. They don't have to be new everywhere, but in the economy they're new. They may have been somewhere else, but they have to be brought in. But you just don't go and bring them in. You need to learn how to do them, how to combine the raw materials, the processing, the spare parts, a lot of things that you need to do. You have to adopt new technologies and production processes. But they are all associated with uncertainty in finding what good an economy can produce. And again, you don't have a master planner there who knows we do X, Y, and Z, and then we excel. These are entrepreneurs through trial and error, who take risk, who face uncertainty to produce these new goods, okay? But a successful investor who does it in a developing economy, not like here, where you don't have patent rights and property and what have you, they cannot claim the full benefit of finding out how to create new products, harness new technologies, and discover the real cost of the economy of producing a good profitably and competitively. Once they do, everybody else jumps on it, imitates it, ease of entry, and they just lose some of the profit of investing in it. So you have then a divergence there between social and private returns. And that is where industrial policy in Africa ought to be focusing on. Unless they do that, the number of entrepreneurs willing to do that and the level of investment to discover those new goods, both are going to be low. And you're going to be left with an economy with unsophisticated goods, lower value goods, and what have you. Now, for African countries to renew their industrial policies, they have to have a very clear objective. And it seems to me that a valid objective ought to be to develop competitive advantage in the production of a critical mass of high productivity goods. You can have one niche here and one niche there. That's not the way you develop an economy. But where do you get a critical mass of new, higher value products? Which entrepreneurship do you need? What kind of level of investments? What are the bottlenecks to discovering those goods among the private sector? You will need specific elements to have a strategy that allow entrepreneurship and investment to come together to discover those new goods and to produce them competitively and create jobs and wealth in the economy. The institutional infrastructure to do that would include political leadership at the top. They have it in agriculture, that's why they are where they are. You will have to have somebody who wakes up every day and thinks about how are we going to do this as a country? Engages with the private sector, with government, with everybody to make it happen. You'll have to get the public and the private sector to figure this out, just like they're doing in agriculture now with the farmers' organizations, the private sector, NGOs, and what have you. It has to have an architecture that allows the different parties to come together and figure out a way of bringing closer the social and the private reasons I just talked about. Because partnership like this easily a way to corruption and a lot of other things, they have to be complemented, just like they do in agriculture. You've seen the website I've shown you, with a peer review process, benchmarking, accountability platforms to make sure that the risk of corruption and those kind of things are reduced. Therefore, you need a few principles to make sure you're not wasting your money, you're not wasting your resources, you're not going back to the policies of the 1960s. Okay? And if you want to do that, you want to bring more entrepreneurs and you want to get a high level of investment in discovering new goods, you have to focus the incentives on new products and technologies as a government to remove the information and coordination externalities and reduce the cost of finding out what goods as an entrepreneur I can produce. Okay? That's basically what each and every entrepreneur has to face. All right? It's better to target activities with spillover and demonstration effects rather than targeting specific sectors, specific industry, and what have you. Okay? Focus the incentives on the products and technologies that are new, that creates higher value products, but do that by focusing on those where you think they spill over and demonstration effect. And to avoid what we had in the 60s, you better have an exit strategy. Otherwise, you're in a path of continual failure and what have you. So that exit strategy should have at least two things. Clear benchmark for success and failure of a policy, of a program. You know when you see this, you're on the right track. When you see that, it's a time to just shut down the shop and do something else. And you have to have built-in sunset clauses. But these kinds of principles are needed so you have the kind of partnerships and coordination activities between government and private sector. Otherwise, the cost of discovering these new products, the new processes, the new technologies just become prohibitive for most of the private entrepreneurs. Now, what instruments do you have that are available to you that you could use? You can, as a government, subsidize the cost of self-discovery, not by throwing people at money or by supporting certain specific sectors, specific company, your cronies, but you can help with things that will bring information to the broader private sector community. Technology trials, market intelligence, feasibility studies, and what have you, and blueprints that can help. You can facilitate access to long-term financing. You can provide research and development, vocational training, and you can do, in particular, what a lot of these countries have not done, and we can discuss that again for a long time, but improve education and health outcome to improve the quality of the labor force for the non-agricultural sector. I'll stop here. Thank you.
Thank you very, very much, Ousmane. Now we'll have Peter Timmer come up and give a set of comments, and then we'll have a discussion. So thanks, Peter.
Yeah. Well, thank you very much for the invitation to be a discussant here. I think we've just heard a quite profound analysis of Africa's agricultural problems, its structural history, and a possible way forward. What I find so impressive is the scope of the vision here. I mean, most of us in the room know about Getting Agriculture Moving as an Art Mosher monograph 30 or 40 years ago, but you're talking about getting industry moving at the same time you want to get agriculture moving, and this is a very ambitious undertaking. I said when I saw the draft of your PowerPoint, hey, this is a course, not a lecture. You know, there's a lot going on here. Let me just see if I can get the conversation going. I don't want to take too much time. The neat little diagram that Ousmane put up is from a little monograph called A World Without Agriculture. And then the subtitle is The Structural Transformation in Historical Perspective, and it tries to explain this paradox of the decline in agriculture, which makes it so easy to take the resources away from the sector. And I think the big question is why did Asia figure out that it really needed to develop agriculture at the same time that Africa thought maybe it could get away without developing agriculture? So what is the basic political economy and dynamics of that basic dichotomy and divergence? It's not that Asia didn't understand where it needed to get to. There's a very famous quotation. The only way out for agriculture is industry. Does anybody know who said that? Mao Zedong. Even with the forced pace industrialization effort using Russian planning, Soviet-style planning techniques, even the Chinese understood they had to develop their agriculture. And we need to understand why that is so. I've been in this business a long time, and I think it's fair to say that I'm known as a professional Africa skeptic. I was asked in 1980 to speak to the Kenyan parliament when they tabled their first white paper on food policy. Wally and I were in, the second draft in 1980 of food policy analysis. We were beginning to think about this integrated framework for how you got agriculture and food and nutrition all together around a poverty alleviation framework. And Harvard had an advisory team in Kenya, so hey, I got invited to go give a talk to the Kenyan parliament after I did a week of field trip around the country, my first visit to Africa. And I came back and I said, you're raping your countryside. And Kenya in 1980 was the showcase of African agricultural performance on the continent. It was doing really, really well. But you looked at the underlying structure and the incentive system and what was happening with the macroeconomy and the exchange rate, and you put that picture together and compared it with where I had grown up in the developing world, which is looking at Indonesia. Whoa, this is going to be a disaster. And that's 30 years ago. 20 years ago, there was a small flurry of activity that USAID stimulated. It was really Dick Cobb's initiative. The lessons from Asia for Africa at a time when this is really growing out of the 1980s, really tough times of structural adjustment going on, not just in Africa, it's going on in other countries as well. And it looks like at that point, from the mid-80s into the early 90s, it looks like Asia's on a different trajectory. It's somehow going to solve the problems of development, poverty, and food security. It's going to solve those problems more successfully than it looks like Africa is solving those problems. And so there were a series of seminars on what are the lessons. And my conclusion, I helped organize this thing, was, well, first of all, Africa has to understand that they're not competitive in the global industrial economy because their wages are too high. You can't compete with, at that point, China wasn't even in the world labor market, but you had Malaysia and Indonesia and Thailand and a little bit of India, you had some pretty serious labor-intensive exports coming out of Asia with very low wages as the fundamental driver. So, hey guys, your wages are just too high. You can't compete. Secondly, your agricultural research systems are simply not competitive. Look at what Thailand, Indonesia, and Malaysia are doing with palm oil. Palm oil was a Nigerian monopoly at one point, and that's gone. And I said, you don't have the research capacity to compete against that. They are going to take those commodities away from you and make a lot of money in doing it. And thirdly, there are just some really serious governance issues where you can't get decisions made that need to be made. If they get made, they can't be implemented. If they get implemented, they go in the wrong hands. And so, there's a series of steps here that are really troubling. So question number one for the discussion, I've only got 4 questions, and they'll be quick now. Question number one is, has the divergence between the growth paths of Asia and Africa actually stopped? Or are we looking at a picture of Africa turning the corner, but not yet becoming competitive with what's going on in the rest of in the Asian economy? I don't know Latin America very well. Question number 2, I found this just startling, that the structural transformation in Africa has been productivity reducing. Simon Kuznets, Hollis Chenery, I mean, the folks who really studied the early development process and the structural transformation made this key observation, that moving people out of low productivity agriculture into high productivity urban manufacturing and services is one of the major sources of economic growth. Jeff Williamson calculated it for Japan historically. When Japan was growing at 6% a year, 2.5% of that was just moving labor out of agriculture into industry, just that almost static productivity gain. You're talking about a backward structural transformation, which I find staggering just because I've never seen anything like that historically on a wide basis. But the corollary you point out is it looks like the surplus labor in the economy is now in services. It's not in agriculture. In Asia, the Lewis model is driven by surplus labor moving out of agriculture into the higher productivity arenas. If it's true that Africa has now basically moved its surplus labor out of agriculture into low productivity services, then we may need a different development model in terms of the role of agriculture. We may need a services sector program rather than an agricultural development program. And then if that's true, the whole role of social services, how do you make them productivity enhancing instead of entitlement enhancing, may really be the core of how you're going to move that forward. Question number 3, and here I really am skeptical. You want evidence-based policy reforms, and you emphasize that you really do believe these policy reforms need to be evidence-based. I don't think you can do that. I think that, at least in the sense of using randomized controlled experiments to figure out what works, the poverty lab folks at MIT, the randomistas, I don't think that's how you do good policy analysis. And so I'm not arguing that you draw this out of a hat, but I would argue that there's going to be a lot of scope for historical research and understanding. Maybe that's what you mean by evidence-based, is the comparative work, the historical work, maybe even some reasonably fancy modeling to do the what-ifs. Maybe that's what you mean by evidence-based, but I'm concerned, and I'm talk to the Gates Foundation, as you do, about this, that we've got a fetish for evidence-based when we can't actually get the evidence that we want. Final point, the productivity gap you showed, it's actually widening in most of the regions and certainly for the continent. The little monograph that I did on the structural transformation, I think argues persuasively that when that productivity gap is widening, it has profound impact on the political economy of the country. That the tensions between relatively poor agricultural workers and relatively better off urban workers is a very divisive political force in terms of the kinds of policies that you end up with. So with those questions, let me ask, I guess Roz is going to come up and share the general questions. Thanks.
Thank you. Thanks, Peter. That was a great set of comments, and I think it really sets the stage for a really good discussion about Africa, South Asia, and just the developing world as a whole. Before we get started, and I think the best way, there'll be microphones that can come to you if you put your hands up. I'll just wanted to start and just ask Ousmane a little bit more nitty-gritty on the ground, and I'll pick on Senegal because you're from Senegal, and IFPRI's office is in Senegal right now. When you think about what went wrong in Senegal, particularly with the groundnuts and why it didn't actually create an engine of growth in that country, what actually happened? I mean, what was going wrong, and which services did people move into? What kinds of physical services are they in right now? So if we're going to transform the services sector, what are we actually trying to transform when you look on the ground? And was the structural adjustment process that the World Bank implemented successful or not? And so I'm asking a little history here, particularly as you look at that generation of leaders versus who's in power now. Do they have any sense of this history? If, as Peter says, maybe take a historical base and use history as a guide. Is there a guide of history for the current generation? You know, Africa's a very young population with a lot of turnover. Do they remember actually what went wrong then?
Thank you. Let me first start by perhaps trying to explain the difference between what we saw in Asia and what we saw in Africa. I do think that there's a historical explanation for this. African nations are young nations. The first generation of leaders in many African countries were not managers. They were freedom fighters who wanted to get independence, idealists and what have you, but they didn't know how to manage an economy. And they didn't have the talent around them to do it as well. So there were a lot of mistakes that were made in the 60s. And they started really to come and hunt the African economies in the 70s and 80s. Okay, so they would, just like people were showing that white paper in Kenya, not knowing what was really going wrong, they thought they were doing great, right?
They were doing great.
Exactly. So until you start feeling the impact of what you did. That happened in the 70s and 80s. So this is the first time that you have a leadership in Africa that can learn from those mistakes and correct it. Now, it's interesting that you're talking about structural adjustment programs. From where I came from, the Granite Basin, the government did quite a lot of things for agriculture, on one hand. And it took a lot of other things away from agriculture, on the other hand. And I think the bottom line was bad for everybody. It was bad for the farmers. Well, it's funny. Well, they were private winners, okay? The farmers were getting services from agriculture, but couldn't do anything for themselves because they're getting, hardly paid for what they were doing. The government was spending a lot of money trying to get things done for agriculture until it ran broke. Actually, Senegal is one of the few countries where the government had to jet set to DC and ask for the World Bank to come in. One of the agencies involved in agriculture had a deficit close to 98% of the budget. One agency, it was 1 out of 5. Okay? So they did quite a lot of things. You look at technological development in agriculture, it was really brilliant, okay? But it was just inefficient, all right? So they paid for it. 40 years later, they were celebrating the same level of production than in 1960. Because everything went down despite all those different things. I think they've learned the lessons. And now what I see a real issue, and we discussed that before coming here, is that what they did wrong in the 60s and 70s, they did not do in many cases because they wanted to do things wrong. In some things, they really believed they were going to work. They were intuitively okay, right? Now, structural adjustment came in. And you're going to get me in trouble because I get clever in Africa when I said that structural adjustment was responsible for the recovery I just showed you. It was messy, it was costly, but it created the kind of reforms that created space for the private sector to do something. I cannot think about anything else that could have happened in Africa that could have such a broad impact across so many countries over such a long period. It's not the rain, it's not the sun, it's not global prices, it's not anything else you can think of that didn't happen the prior 40 years. So, and I do think that the reforms they took in macroeconomic and sector policies did put these economies back on the path to growth. Okay? Now, with the new leadership and political pluralism, will they learn the lessons? Will they know what was wrong that led to social adjustment? Will they know what didn't work then and might work now? And what didn't work then will never work. Okay. In other words, is there a risk of policy reversal to the same intuitive policies that led to the disastrous outcomes? And that's why I think the renewal process under the Comprehensive Africa Agricultural Development Program is very important to make sure that there is benchmarking, there's learning, there's peer review to avoid those kind of mistakes.
That's great. What kind of services are these people in?
Oh, okay. Thank you. Now, can you imagine 40% of the population in an African country doing something useful in services for the other 60%? Just think about it. And you look at all these economies, 40% are in service, 20% in agriculture, 30% in manufacturing. My former colleague called it negative diversification, Tom Reardon, in the early 90s, when I saw people running out of agriculture, doing something, selling matches, candles, little things at the street corner. So basically, that's what they do, all right?
So, Peter, that's your service sector you need to reform.
Well, I mean, remember, what, 30 years ago in Indonesia, what was happening out in Central Java and Yogyakarta, in the really poor districts, you'd see kids who were not in school, who had enough capital to buy a pack of cigarettes and then went out to the fields and sold them one at a time. Now, getting rid of that kind of service labor was a good thing. When they went to school, and B, the wages were just got high enough that that kind of activity, nobody would do it any longer. But what you're talking about is sort of an immiseration process. If people, what's squeezing them out of agriculture? We all, at least those of us with Asian orientations, think of Africa as being land abundant. You know, there's no reason why you have to exit agriculture. You can just go cultivate more land. What is the force that is driving them out of agriculture into these incredibly low productivity, low income service jobs?
As I say, everything is relative. I think if you take out the first 10 years of independence and the last 15 years, African economies have been in some type of crisis all along. Okay, and agriculture suffered the most during those times. Just imagine, 17% of Senegal's economy. How many people can live off it? It's just, all right, so people are just going to leave it because there's not enough substance in there.
It's just sheer poverty.
That's what it is. And at some point, you try your luck somewhere else, okay? And I'm going to say here something I think really is going to happen if things that are now taking place in Africa continue, in particular this level of energy around the agricultural sector. If African countries sustain their efforts under Cabot, the share of agriculture is going to go up in most of those countries. Okay, and that's going to bring a little bit more power into the engines of these countries. And the reason why I believe that, and that brings me perhaps to addressing a little bit the evidence-based issue, is not a randomized trial or random misters, but it's more about, here is my, the way I would, the metaphor I will use. I used to say to my colleagues at the bank and somewhere else that it is much easier to manage the US economy than to manage, let's say, the Senegalese economy. And here is the image I have of it. If you go to a doctor's office and you have a lab report, a recent graduate can do something with you because the lab report says what's wrong with you and all these different things. But walk into a clinic without a lab report and you want to be treated. You need a seasoned physician who could look at you and say, I've seen this before, this kind of things. Okay. Now, the African economies are just like a patient without a lab report in many cases. So the evidence-based transition we're talking about is to create a lab report for them. Not randomized trial, but to know a little bit more about the economies. What's the level of productivity? What are the prices? What are the sources of growth? How are people being impacted by growth? You know, all those different things to what are your options in the long run?
So that's your RESX.
That's what the RESX is doing.
Right.
Okay. So basically, given the parameters to be able to to plan better, to monitor better, to benchmark better, to learn better. That's basically what it is. They used to be navigating in the dark in the past. Okay. Just like we've seen in the white paper in Kenya. So we want to produce a lab report for the African agricultural sectors, for the individual countries to be able to have a better diagnostic and a better chance for the physicians to treat the patient.
And I think what's most fascinating about what you've described is that it's not internal to the country, but the peer review is by leaders of several other countries too. So countries are giving each other feedback, and so you're getting this region-wide sort of experience that's moving everyone forward, from what I understand.
Right. Or if not external leaders, at least external experts. Okay. So experts from across Africa will review a country's program and investment plans. What you did in Nairobi 30 years ago, 40, now they're asking for African experts to do that, and in a much more, I think, open and frank discussion. Yeah.
So, questions?
There's going to be a microphone coming.
And you might want to just introduce yourself very quickly.
Yeah, hi, I'm George Richard. I'm an alum and parent and interested in the topic. What gives you confidence that a kind of a unified policy approach is going to accelerate individual country performance, where I have a hard time being in industry thinking where that's worked elsewhere in the world? So why does this groupthink necessarily advance, you know, addressing some of the issues you talked about? I'm just curious on where that comes from.
Yeah.
That confidence.
Yeah, should I?
Yes.
Okay. There are two things that belong to it. I think that there's that political momentum at the continental level. Okay. This program is a program of the African Union. Okay. Countries sign on to that program and are expected to deliver against it. But then the collective thing is contributing to doing things better through simple and pure peer pressure. Okay? Because governments are being benchmarked now. When they sit at the regional level, they look at how well is Senegal doing compared to how well is Mali doing and compared to how well is another countries doing. Okay? But they have, in the process of rolling out the program, created instruments that bring that collective. It's not countries that chose to be part of it. It is part of the instrumentarium of implementing the program. So they've asked regional economic communities to create a coordination process within which the peer review and the mutual learning takes place. Okay? Why they accepted it, I don't know, frankly. I was stunned when the first set of governments, 7 of them, the ministers traveling outside of their countries with their strategies and investment plans, putting it in front of African experts to evaluate and give them feedback to take back home and improve. I mean, we're all stunned.
I'm not surprised that the group came together and signed it.
Yeah.
I'm more interested in your view about why that's an excessive.
Why
is that an appropriate approach to take?
Because first of all, there's a lot of learning and sharing to be done between those governments. But also, imagine, those economies are very small. There's none not a single country in West Africa that can develop its economy, most of Africa, I would say, independently from their neighbors. The borders are porous. There's a lot of spillovers, a lot of overlapping things. If you don't know what your neighbor's doing and take that into consideration what you do, everybody end up losing.
In Asia, what we call the neighborhood effect is really quite powerful. Yeah. And at least in the 70s and 80s, the successful countries were watching each other like hawks. They wanted to know, Indonesia wanted to know what Malaysia and Thailand was doing, and Thailand wanted to know what was going on in Korea. And so that's a real spillover effect. I think it's healthy that they really do want to know, and they will end up feeling the competitive pressure as others get out in front of them.
And there's real benchmarking going on. I remember we went to, with some colleagues from the World Bank to Singapore and several countries there, and we went to talk to the management of the Changi airport. And I think they were talking about, the port, actually. They were getting things being said to them like, this country, their port has a turnaround of, I don't know, 1.5 minutes. I want you to do it in 1 minute 25 seconds. Okay. So that kind of benchmarking and peer pressure really do produce things. And I think that the reason why these countries are willing to subject themselves to that kind of review is because of warning and having to be part of that collective process. Yeah.
So Scott and then Tim. There's a mic right behind you.
Thank you. Very interesting presentation. Scott Roselle from Food Security Environment Program. Yeah, I'd like to know, I found your presentation fascinating and basically, going back to the basics and get agricultural going again. And even saying in some of the successful countries, you've seen this reverse flow back into agriculture and it's, so what we hear mostly in the press these days is the horrible effects of high prices and biofuels pushing energy prices, pushing out, expanding the production of biofuels and high agricultural prices all around the world. But it seems to me that this might be a real opportunity. And that yes, we really have to worry about this marginal service sector over here, and there's have to be policy. I mean, obviously they're super vulnerable to this, but in a longer run, more dynamic sense, if it can get, I mean, you'd much rather be investing in an industry with high prices than an industry where prices fell for 100 years in a row. So what do you think about that?
Thank you for that question. I may get in trouble here again. But I frankly do believe, just like you said, that the people who are crying disaster are doing it for reasons I don't understand. This is, again, the first time in history that a crisis is an opportunity for Africa and not coming from Africa, dealing with agriculture. It's not related to droughts in Africa. It's not related to floods in Africa. It's not related to civil strife in Africa. Actually, the production base in Africa is stronger now than ever. So it should be seen primarily as an opportunity by African countries. But that's not the mood in the international community. The way they talk about this looks like this is an African crisis. Okay. You look at the prices globally, and you look at the prices in Africa, outside of wheat and rice, the increase in price is even much lower, a fraction of what you see in global markets. People don't make the distinction. And, second, you look back 5-6 years ago, prices were higher in some of those countries, but there were no riots, there were no protest marches because it was not politically being beamed on people day in, day out. Okay. So it wasn't a real thing, it was a perceived thing. Yes, prices were higher, but it did not reach crisis proportions. People may not want to hear this. They should have seen this as an opportunity to invest in solidifying the production base in Africa. Looking forward, you look at the trends in productivity, in labor cost, in factor cost in Asia, you look at them in Africa, you look at them in Latin America, Africans should be happy to see rising global food prices. Okay? So the mindset should be, how do you invest in capitalizing and not going back and seeing this as a crisis in Africa and doing the wrong things, undoing the health reforms of the 80s and 90s. Governments are being overexcited because somebody's telling them there's a crisis coming. They have a stronger fiscal position now in most African countries due to 10-15 years of positive growth. You have more populism because of democratization. So if you add to that this aura of crisis and sense of urgency to do something, you get wrong measures. Okay? And I'm really concerned that we can get policy reversal due to the way people are looking at this crisis. Thank you for raising that, Scott.
Tim?
Is this on? Tim Gosling, FSI. Thank you. It was very interesting
exposition. I've never really understood why agriculture in Africa has not progressed, and I've now got some ideas. But one of the things that I do know about Africa is that, at least from the statistics, that the trade between countries in agricultural goods is very low relative to, you've got 50 countries there, and at least if you look at the published statistics, there's almost no trade goes between neighboring countries, and one country has a harvest failure and trade doesn't come in from the next country and so on. And I detect a little bit of that continuing in your exposition of the type of planning that you're thinking of, that every country has to grow at 6% and every country has to put 10% into agriculture. If you're really developing an Africa-wide market, that isn't going to happen. Some countries are going to have more on agriculture. Some countries are going to spend less on agriculture. So I want to ask you, to what extent is the African fragmentation problem, the lack of integration, something that still has to be dealt with? And then just to sort of follow up on that, how do you see things like the EPAs, the way the EU is essentially forcing the African countries to integrate in blocks with each other? And of course, within Africa itself, all the myriad of free trade agreements that have been signed over the years and have done nothing at all. Where does this fit into your policy prescriptions?
Okay. Thank you. On the trade, it's always been higher than documented. There's a lot of trade happening, but there's nobody there to document it, especially in agriculture, quite a bit. So, but the formal numbers on it are very, very low, although they're showing an upward trend. I think it's an issue of, yes, cost and relative competitive advantage should dictate the flow of trade, but at a certain level of production, there are very few countries that really do produce the kind of surpluses that go across borders. Of course, you don't have an average of a country. It's a zone that produces, and they may be neighboring zones. So in those zones, you have that going on. But those are the things that you don't have in the statistics. So they don't ship from ports and fly out of airport, export to the neighboring countries. They're just people walking across. So it's happening, but it's just not really being documented as it should. Yes, if everybody produces more, somebody will have to buy from somebody, right? And I think that's what you're saying. This brings us back to what we were just asking. This bringing countries together, doing this collective review, is to create the scope and the opportunity for people to look at the complementarities between the different countries. But what you will find is actually you have basins that cut across countries for rice, for maize, for cassava, and those actually will supply different parts of different countries. It's not going to be one country being the surplus for another country. If they do things right, that's what will happen. Okay. But it's clear, not every country need or can achieve 6%. I think politicians decide what they decide, so they come up with those two numbers. And there are even countries that don't need a 10% budget increase. They're already doing fine. Ghana is about to achieve the MDG with what it's doing. So others need more, others need less. But it was a political decision that they had there. On the EPA, there's a lot of resistance in Africa. Okay, it's very, and I don't know what was going to happen with it. I was part of a meeting recently, and it looks like even the East itself is cooling on this. Okay, for me as an economist, the issue that I would find a little bit of a problem is opening African economies to heavily subsidized agricultural sectors and wanting to compete with them. Okay, and I think that's certainly will be a real issue for the African economies. What it brings as a complication is that in any given regional economic community there, many of the countries would qualify anyway for, at least are already benefiting from preferences and would not lose much. But there are countries, a couple also, that would lose. So it's creating a wedge between the countries. Like in West Africa, Ghana, Ivory Coast, and Nigeria are under pressure to sign. But the others, wouldn't lose much anyway. So it's creating a problem between the regional blocks and the European market, but also creating a problem within the regional blocks. And it looks to me like the chances may not be that great. I may be wrong, but there's a lot of pushback in the regions. Obviously, they must have known that that's not in their best interest.
Can I push you just a little bit on Tim's question? You pointed out that there's going to be plenty of demand going forward, and especially in the urban areas. Now, the big urban areas are primarily on the coast, and at least over the last few decades, they've been provisioned from outside rather than from inside. Do you see any way to sort of turn around that that trade pattern and have more of it produced, not necessarily in the country of the city, but as Tim suggests, in the high productivity areas wherever that would be competitive? Yeah,
I think that the chances of a lot of that supply coming from the domestic economies are higher now than before. When you went to Nairobi in the 80s, there was a law that prohibited people from moving one bag of rice between two districts and what have you.
Across district lines they couldn't do.
Exactly. So those things don't exist anymore, all right? Traders were being licensed before they can move stuff, okay? Prices were being set by government. people are being sent to harass traders across the borders and this kind of thing. So all those things have gone down a little bit. And looking at what I see as a renewed dynamism in the African agricultural sector, some of this demand can truly be claimed by the domestic sectors, partially because they're products that are really only grown in the regions. White maize is not broadly traded. Cassava is not really that kind of a tradable because of its size. Millet and the beans and those kind of things. And a lot of these demand comes from there, actually. I eat now millet products in Washington, D.C., because there is an industrial sector that processes the traditional meals ready-made that can be sold in D.C. So these are the kind of urban foods that can stimulate growth in agriculture.
And where is that millet grown that you're eating in D.C.?
In Senegal and Mali.
Really? Wow. Okay. You got an export market.
There you go.
I think Tom Jane has also documented that 90% of horticulture is domestically consumed and sometimes not even urban, so it's interesting. We have David LaBelle, David Abernathy, and then Wally.
So I'm David LaBelle from FSE, and like everyone said, that was a really great set of talks. I can't decide which question to ask, so I'm going to throw both out there, and you can choose. One is on this this comparison we've talked about with Africa and Asia, and obviously you guys focused on the policy differences and pretty convincingly. But there's the factors of geography. There's the factors of Asia already having irrigation in large measure in place, and there's just the differences in soils and how heterogeneous Africa is, and that's often been claimed as a big reason that. So I'm just wondering where you guys view those factors as fitting in as playing a role in slowing down Africa relative to Asia. And then the other quick question was thinking forward and what Africa is going to have to deal with. It looks like that Asia didn't seem to is foreign investment, foreign purchases of land, and how is that going to be a net positive, net negative? What are the thoughts on that? Thanks.
Questions are great, so why don't you take the first one?
Let me respond to the first one, because one of the things I was so astonished at when I saw Machakos district in Kenya was, sort of every 10 feet there was a different cropping system in terms of altitude going up and down the hills and through the valleys. And I'm thinking in Krawang, as far as I can see, it's irrigated rice. So you get a breakthrough in one important crop, and if you do the right things, Burma has not, but if you do the right things, you can have really rapid productivity increases with, I don't want to call it simple agricultural research approaches, but fixing entire cropping systems that change every 3 or 4 miles struck me even at that point as a much, much more difficult task than what the rice basins in Asia were facing. On the other hand, there's incredible diversity of agriculture in Asia as well. They just grow different crops in Sumatra than they grow on Java. So I don't think geography is the sole explanation of the difference. It's clearly a factor. It probably raises the cost of improving productivity. But let's face it, we don't know because they didn't try.
Thank you. I do agree that geography plays a very important role, but I don't think it's the determining role. It sets the parameters for what man can do, but it is man's ingenuity and drive and innovativeness in search for solution. I did, at some point, point out something when I was doing my thesis, and it was about regional trade and this kind of things. And then I just couldn't accept them. People saying, well, the sun shines everywhere in West Africa, it rains everywhere, so you can trade with one another because you can do everything. But then I turned around and said, how come Senegal is so good at doing groundnuts and Mali is not, and the Gambia is not? Okay, so in other words, the accumulated technological know-how and the investment in such assets can overcompensate constraints or, let's say, other obstacles you may have due to geography. Okay, so it just determines the parameters of what you have to do. All right. So I think, and if you look back at what happened in Africa, most of the mistakes were man-made. Bad policies, not because people wanted bad policies, just mistakes that do happen. And I used to say to my students at Stanford, and sorry, Johns Hopkins, that's nice. I used to say, show me an African government that has done the right policies for 5 years consistently and sustainably, and I'll show you a success story. Okay. So the geographic elements are there, but it was the man-made part of it that really was the most determining factor of the outcome that we have seen over the last 30, 40 years.
Can I reinforce one point? Yeah. Agricultural productivity has a huge input from farmer knowledge. Yeah. I mean, Wally's from Iowa, I'm from Ohio, but I still can, what look like identical fields, but owned with a fence going through, and one farmer is a soybean farmer and the other guy is a corn farmer. And it's because that's what they've learned. They've really figured out how to do that crop. If you move the prices enough, the soybean farmer will grow corn and the corn farmer will grow soybeans. But under normal circumstances, because they've invested in year after year of figuring out exactly how to make that soil most productive, that knowledge is increasingly the source of the productivity gains.
So on the land acquisitions,
Oh, yeah.
I think in 2008, 2009, 42 million hectares were acquired by foreign sources and 75% in Africa. And so is this a plus or a threat?
First of all, thank you for using a neutral term, land acquisition. I've heard land grab, heard other things. Again, here when I discussed with some of my colleagues, I said, how comes everyone wants foreign direct investments? But then if it goes into land, we say it's bad. Okay, FDI is FDI, all right? But what it does in the country is a different matter. So I don't think that foreign direct investment in land is de facto a negative thing, all right? You have a complementarity. People have a surplus capital, and these African countries have surplus resources, and they want to bring them together. But there's one thing. First of all, a risk I see, and one principle I would think would be important. There is a big difference between Africa, Latin America, and Asia, which give the African countries some hope that they can overcome poverty in a much more faster way through agriculture. It is the strong nexus between poverty and access to land. Most poor people in Africa have access to land, most. If you can make land more productive, then you can lift people easier out of poverty. If FDI in land cuts off that nexus, separate the poor from the land, then you've lost one of the most powerful tools you have in Africa to lift people out of poverty. So they should not have mechanisms and investment that takes poor people off the land. But there are a lot of other models that they can follow. Still get FDI. We have outgrower schemes, contract farmings. You can even have joint ventures, a lot of other things you can have between the foreign investors and the African farmers. But that nexus ought to be kept. How you do it depends on how you can innovate in a country. That's important. But second, where I'm really concerned, and I don't have the hard facts to prove it, but I do feel that there may be a derived secondary market in Africa for land. And this time, it's not foreigners investing, but the elites buying land and waiting and hoarding, knowing that somebody's going to be coming. And I don't know how you control that, because they have the upper hand. They can go into the rural areas where you don't have very strong local administration, get into deals and put their hands on lands and just lay in wait, because they know somebody's going to come in sometime, somewhere, and want to buy the land. Okay? So that secondary market is, for me, of biggest concern. Because if that one is under control, then you can negotiate the terms with foreign investors. But that one is not observable. It's in the dark. It's going to be very hard to negotiate those terms and make sure that poor people are not taken off their land. And I don't know how to solve that one, but I see that as being a big risk.
Thanks. David Abernathy.
Since you've given my name, I won't give it. Implicit in your argument about the value of simultaneous development of agriculture and industry in Africa is a heavy reliance in the industrial sector on processing agricultural goods. And I wonder if you could give some specific examples of successful industries, including small industrial operations, that are involved in taking agricultural inputs and making them into something of higher value, either for export or for the massive urban population that you've already and very successfully indicated is so important. And to put it even more specifically in the future, supposing you were the entrepreneur who wanted to take an agricultural input and add value through industry, which agricultural product would you choose? And in which country would you choose to set up your factory?
Thank you very much. But let me first say that the contribution of agriculture to non-agriculture goes beyond the raw material. Peter, in his book, quoted the Miller-Johnson model, and John Miller was the one who brought me to the States, actually, in '89. Oh. So, and he was my mentor for a while. There are a lot of other ways of that happen, of course, and one of which is creating demand for the non-agricultural sector, the goods that are being produced there. When I was growing up, again, in the Grounded Basin, you had a thriving bicycle industry, mattresses, all those different things, because farmers had money to buy them. Okay, so what agriculture does for the non-agricultural sector is to create a demand for the goods that industry produces, because those goods are not going to be sold to the United States. They're going to be sold in the rural areas and secondary town and what have you. So that's very important. Second, Peter was talking about the wage issue in Africa and how uncompetitive the economies were vis-a-vis Asia. The performance of the agricultural sector determines food prices, which index to wages, and then therefore push your wages up or down depending on how well agriculture does. So I just wanted to mention those and other things. Now, on the raw material basis, you look at cotton, West Africa, they could sell cotton at 55 cents a pound and make a profit, when the production cost in the United States was 73 cents a pound. Last time I looked, about 4 or 5 years ago. Okay, so, and those were smallholders, and they're selling to gineries, some of them parastatal, some of them private. You look at Senegal and groundnut, Nigeria and the Gambia, for a long time, commanded 60% of the world groundnut oil production. Okay, it happens. You looked at sugar in Mauritius. So the examples where smallholders are doing it. You look at cat flowers and others in Kenya. So those did happen, and they can happen. However, the economic environment has to be conducive to competitiveness, to low cost, and to competitive trading costs, and a lot of other things that are more determining than just the price of the raw material. Okay? If I was to process, actually, I do on a farm. As we speak, actually, I'm working on it. And I will be processing for urban demand, and I will do it in Senegal. I will be growing vegetables and fruits that are selling extremely well in the urban centers. But the next stage is to add value to that and to process it locally. And that's what I will do as well. I will do it in Senegal.
Excellent. Well,
I'm Wally Falcon from FSE. Ousmane, you just mentioned Johnson and Mellor. You mentioned John Mellor. I'm going to go now to the Bruce Johnson side of the house. Yes. I was surprised that you didn't talk a little bit more about the demographic transition in the process of structural transformation. Africa has come quite a ways on, say, total fertility rates, and my guess is that's one of the reasons things are looking a little bit better. Could you talk a little bit more about where things are going on the demographic side, whether there'll be less headwind because of better demographic statistics, or whether that's still 20, 30 years out?
Well, I'm not following that very closely technically to be able to authoritatively talk about that. But what I would say is that, yes, fertility rates are going down, population growth may be slowing, but it takes a long time for that to make any major changes. And I do think that with the depth of problem we had in the past in Africa, and the policy issues, the investment and the management issues, those are much more important than the policy factor right now. They have a lot of scope to get a lot of traction just by solving those little things. It will take a long time to change the population dynamic. If I were a government, I will look for other things that I can do within the next 25 years while I buy time to act on having an impact on population growth. What I do now is going to have an impact in a generation, probably on population. I would think more in terms of health issues, in terms of education, the hands that I have right now that are not productive enough to make them productive. I think there's a lot of scope and a lot of opportunities there to work on that. I think the population question is going to solve itself. There's something that's inherent in societies that reduces fertility rates and that lowers it. It will be, for me, not the first thing I will jump on in terms of trying to control and bring it down to get a better economic outcome because of the urgency you have right now and what you could do in the short run while you're still handling that.
Can I follow that? The Gates Foundation is sponsoring this series. If you were sitting up in Seattle and had $1 billion a year to spend in Africa, where would you put the money? If it's new money that could be allocated to where you think the most productive outside resources where they would go?
It's going to be, of course, depending on the country, on the options and opportunities you have.
Would you pick countries, or would you spread it around?
$1 billion spread around is going to be very thin. It's not going to achieve much.
And it's a lot for any donor. Okay, so
exactly.
You're going to pick winners?
Yeah, I'm going to pick at least countries that have the determination, the discipline, and the commitment to do something, okay? Where I think they're the conditions for a good return, all right? I would not pick the countries because politically I like what they do. I wouldn't pick countries because I think they're the poorest country. I wouldn't pick countries for any other reason, but do I have a committed government that's willing to put the resources and to do the kind of policy that will advance that country? And I put a critical mass of resources, okay? Then I look at what the economy as a whole needs to grow better. I'm not going to pick sectors in a sense, because nowadays, what agriculture needs is what industry needs. The infrastructure, the educated people, the rule of law, the quality of institutions, the ports and the airports, it helps everybody when you do that. And then let the private sector come in. Because once you do this kind of things, you're going to get the private sector coming in as well and do that. Okay? And where they have obstacles, target the money into solving it. But there are a lot of things you can do right by all the different sectors at the same time.
I think that's a great note to actually end on. And we're right up against 6 o'clock. So let's thank the speakers and stay around and talk after.